Hello, friends. Great to be back. This is the first of a series, podcast series on digital lending. As everyone is well aware, India has witnessed a sea of digitization, and there are broadly two reasons for that. One is the penetration of internet and smart devices across urban and rural areas. And of course, the second is opening of bank accounts for most people in the country. Both put together, we have seen great impetus in terms of the fintech space, the financial digital space, and within that we've also seen a surge in digital lending. So this is the first of a series where we are going to be focusing on digital lending, and in this series we are going to be talking about P2P lending. Now the first question which comes to our mind is, what is P2P lending? P2P lending is nothing but an intermediary providing the services of loan facilitation via online mediums. So in other words, you can imagine this to be like a marketplace of loans where there are different lenders and borrowers who come together to lend and borrow. And here, interestingly, the lenders also can be individuals like you and me, and also the borrowers can be individuals or non-individuals. But more importantly, the entity which is operating the platform, which is the intermediary or who's the P2P platform provider, needs to be a regulated entity. And this is one very interesting fact. This sort of platform can only be run by a NBFC, and NBFC means non-banking financial company. So to sum it up, P2P lending is nothing but a marketplace of a platform where there are multiple borrowers and lenders which come to lend and borrow, and that platform needs to be run by a regulated entity, which has to be an NBFC. So we have a legal framework surrounding peer-to-peer lending platforms, P2Ps. It has been there since 2017. It was not very robust initially, but over the last few years, for reasons which I mentioned on digitization, it has gained great importance. But more interestingly and more recently, there were some very important updates to this law, which happened in August and September. With me on this podcast, I also have my colleague who's an expert in this field, Palak Kapoor. Palak, would be great if you could come in and shed some insights, basis the amendments which have happened and the industry impact on the same.
Sure, Huzefa. So this has been a very interesting space over the past 6 to 7 months because of the changes happening. And if you have been following the news, some NBFC P2Ps are struggling to keep businesses running, and some are even considering closing shop because of the recent amendments that happened in August and September. So just to give you a broad overview of what these changes are. The first is that there is a core emphasis on the NBFC P2P being an intermediary and limiting its role to just being an intermediary that is facilitating the lending and borrowing operations. Earlier, what the directions issued by the RBI said was that the NBFC P2P cannot ensure credit guarantee or give credit enhancement. Now, this language has been further expanded to say that they cannot assume any credit risk, and if there is a loss that arises out of this borrowing operation, that has to be shouldered by the borrowers or the lenders. So that is where the restriction is being created, and it is being confined to being an intermediary. The second big change over here is that the fund transfer mechanism, or the fund transfer timeline rather, has been reduced. So for instance, if I as a lender have to lend some money, first I'll send that money to an escrow account which is managed by the NBFC P2P, and within 1 day of this transfer the money has to be sent to the borrower's account. This increases the number of transactions that an NBFC P2P has to oversee. Now, the problem here is that this in effect increases the operational costs as there are more transactions. And who will bear this operational cost? The borrower. Now, what happens here is that it increases the annual percentage rate that the borrower gets the loan at. And then it makes the NBFC P2P a less lucrative option from a borrower's perspective. Huzefa, if you have any inputs on this, would love to hear that.
No, I think it is perfect, right? I think just to kind of sum it up for our audience, essentially the amendments kind of give direction to three broad buckets. One is functionality, which means that the functions which actually the peer-to-peer lending platform can actually perform. And as Palak rightly said, it has to be in its classic sense as an intermediary, not to kind of influence either ends of the spectrum. Second is on the fund flow. Previously, money was fungible, but going forward, there has to be independent lender borrowers account which needs to be maintained. So mingling of funds may not be possible, and general functionalities which cannot be circumvented through use of technology, such as matching of borrower groups and so forth and so on. The other interesting point, which used to be happening over the past couple of years as this industry grew, was the peer-to-peer lending platforms were actually outsourcing their tech play, which essentially meant that when a user landed on these platforms, they were white-labeled and being operated by third parties. And the actual NBFC, who was the regulated entity or who had the license to run the peer-to-peer lending platform, was at the back end. So the front face from a user perspective was a normal tech company. Now that may have gone against the overall intent and spirit of these guidelines, and this has recently been clarified that at all customer user touch points, there has to be explicit mention of the name of the P2P NBFC, including their brand name. So, there is no sort of misinformation or misguidance to the user when it comes to who's running the platform. So this is, an overall summary, but, Palak, would love to have you in from a, go forward industry impact perspective.
So, in light of these changes and amendments that have come, what is being understood is that there is a move towards the traditional approach of borrowing and lending, where a lender selects the borrower to whom they want to lend the money to. And this would also increase the amount of consumer transparency that is there on these platforms, and that the fact that this is not an automated process anymore. However, a concerning factor here would be that if NBFC P2Ps have certain outsourcing arrangements with the third-party companies, as you rightly mentioned, they may be technology companies. These arrangements would have to be relooked into, and they have to be calibrated with the amendments. So, any closing thoughts, Huzefa, on this?
Yes, I think, for our audience, this is a quick, high-level takeaway from a regulation standpoint. But just, to kind of conclude our podcast, any sort of models in the digital payment, fintech space, lending space, one needs to be mindful that, the lines were gray when it came to fin and tech, which means that, what gets regulated and what is not regulated and falls under the guise of technology. I think over the years, in the interest of consumer transparency, ensuring customer grievance redressal, user interest, the RBI is the lines and the shades of grey are getting more and more black and white, and it is better to err on the side of caution and move towards a more regulated approach. On that note, we will shortly be following this series with a second one, series 2 of the overall fintech space, and there we will be focusing on various models on digital lending. So stay tuned, and we should be back shortly. Thank you all, and thank you, Palak.